Hi, I'm Sean Fenton, the Chief Investment Officer at Sage Capital. Welcome to our review of May 2020. It was an interesting month, provided a lot of challenges across the market. So pleasingly we continue to deliver positive performance across both of our funds, but it was a very interesting market. We saw optimism come back again as we started to focus on the prospect of opening up economies again, and we've got good support from liquidity from central banks continue to drive risk tolerance higher. So that saw a few very interesting developments across the market. We saw very early on a continuation of strong growth in growth stocks, really technology companies, those with exposure to the cloud and software were doing very well. We saw some very good performance from online retailers who are benefiting from an accelerated switch from in-store to online shopping. We saw a bit of a mini bubble develop in the payment space with buy now, pay later providers such as Afterpay surging to record highs after some interest from Tencent on their register. We also continue to see gold drive higher, driven by a lot of liquidity out there, concerns that central bank money printing would eventually erode the value of all currencies. So gold was very supported, and with a weaker Aussie dollar across a lot of the month, a lot of the Aussie dollar gold stocks did very well. We did continue to see a bit of a rotation though towards value stocks towards the end of the month, and we saw a big rally across building materials companies. They continued to bounce off their lows, driven by expectations of fiscal stimulus, some grants to try and stimulate home building. So that drove some rotation in the market that continued to move through. So whilst we remain very cautious about the long-term economic impacts of the lockdown, how that might threaten solvency across many companies in the economy, and how that we're not really seeing that with a lot of forbearance by banks and bad loans not really hitting the market. In the short term, liquidity is winning and it's driving risk appetite. So we've also got to be pragmatic and reflect what's actually happening in the market. So to that end, we've continued to drive a bit of a rotation towards cyclicals and value across the portfolio. So as well as closing down some of those shorts in builders that started to rally hard, we've taken profits across a lot of our better performing growth stocks across the technology space and the healthcare space, and rotated a little bit more towards some of the laggards that are showing strong relative value. So we've moved overweight banks for the first time since post the global financial crisis, and also have some exposure there to some of the industrials that have been a little bit beaten up and are now starting to recover, with some good exposure across diversified financials as well in terms of the insurance space and some of the credit collection companies. So that's giving us a little bit more of a tilt towards an ongoing recovery in cyclicals and value stocks. That said though, the environment does remain very uncertain, so we don't want to take that too far and want to remain reasonably neutral across our portfolio. So we've still got some strong exposure to consumer staples such as supermarkets that have lagged a little bit, and we'll continue to look to take profits on those stocks that outperform too strongly. Looking forward, uncertainty does certainly reign across the markets, and that dislocation that we're seeing between the economy and the stock market is likely to continue. Central banks are doing a great job of propping up risk appetite, but in the end they're really solving the symptom rather than correcting the problem. So there are problems in the economy. We've got issues in terms of limits on migration that are impacting the education sector, the tourism sector, and ultimately demand for housing and housing construction that may not be fully offset by government stimulus. So there's a lot of risks out there. There's risks of solvency to companies and individuals that will eventually flow through the banking system. So it's certainly not clear that liquidity is going to solve all these problems in the long run. So we remain pretty well balanced and attuned to any shifts in risk appetite there. Thank you for your interest in Sage Capital and listening to this update.